When we compare the valuations of many financial technology companies, they are generally trading at prices that are over $100. Some, but not all. Of the fintechs, a few are priced at an affordable rate of less than $100 each and still offer a combined per-share price that's still under $100. Luckily for you, Fortune Fastlaner, we listed the 3 solid fintechs to consider if you want to invest in a meaningful number of shares without breaking the bank. Remember that while the first step is completing any of these amazing videos, the second and possibly more important step is taking action even if it's an imperfect action. Let's dive headfirst into that list. Number 1. Marqeta. Even though Marqeta isn't at the forefront of their business, their product may already be in your household, possibly without you knowing. Luckily, Marqeta is bringing digital payments to the rich world we live in. The company provides software that retailers can offer customized credit card accounts for consumers. Unlike the simple description, Marqeta provides technology that merchants wish they had access to years ago with digital payment providers on their side. The new technology is available now. Digital wallets, real-time notifications, customizable platforms, and spending controls are just a few features of Marqeta. And people are trying to catch up with it, at least the part of them that are in the know about card payment technology. Marqeta recently joined MasterCard's Asia-Pacific Network Enablement Program, and just a few days ago, they also announced a partnership with Buy Now, Pay Later outfit Klarna. In early May, Marqeta and Evolve Bank and Trust announced an agreement to provide more robust card payment options for banks' business customers. There are numerous reasons analysts are projecting 40% revenue growth this year, including the 78% top-line spike last year. Marqeta, while not yet profitable, shows progress with their sales, and the firm is showing strong growth, making the name a strong prospect for investors who are willing to risk a little. This company has risen in popularity as one of the most sought-after fintech stocks over the past few years, and has reported an increase in revenue this morning. Despite this, shares fell by more than 4% in pre-market trading Thursday. Marqeta experienced a wider first-quarter loss of $60.5 million, or 11 cents a share, including charges for the write-off of unamortized expenses and marking down deferred revenue estimated to be impaired. This is compared to a first-quarter loss in 2021 of $12.8 million, or 10 cents per diluted share, and positive EPS of 5 cents. Marqeta analysts' expectations were around 9-cent losses per share, according to projected earnings averages from FactSet estimates. Number 2. Ayden. When asked to name a specific digital wallet, most of you will think of the company Pieter Holdings, and rightfully so. The company pioneered the payment aspect of online shopping when credit card companies themselves weren't quite up to the task. And though alternatives are now available, PayPal still facilitates roughly half of the world's digital wallet payments. If you only think about PayPal as the main consumer payment gateway, you're wrong. We're not talking about Block, which is a company for small businesses. We're talking about Netherlands-based Ayden, which is gradually but surely creeping into PayPal's turf. If this sounds new to you, don't worry. Ayden is doing well. About 60% of the company's pre-tax operating earnings, booked during the second half of last year, came from Europe, the Middle East, and Africa, or the EMEA region. More than that though, those EMEA earnings were up an impressive 41% year after year. The American Depositary Receipt, Ayden is traded on exchanges, not over the counter. While listing an ADR like this can be complicated and expensive, Ayden has a $50 billion valuation that makes it more akin to a listed equity company than an over-the-counter company. Options for payments can vary tremendously, They range from a simple haircut to more complex transactions with digital receipts. B2B payments are more complicated than restaurant transactions, so let's not go to that route either. Cryptocurrencies? Not a chance. With the rise of fintech and companies' reliance on digital payments, we have been researching 3 stocks and have now settled on Ayden based on our investing preference. We do not like the current trend where .com companies are becoming less valuable, which is why we are researching companies like PayPal and Adyen. In this video, we will mostly focus on our investment in Ayden company stock. So, eBay's new PayPal is Ayden? One helpful feature that is immediately apparent is that the payment companies are quite different. Most of us are probably familiar with PayPal, which is one of literally hundreds of methods that merchants take as payment. I'll bet the most popular and ubiquitous one. Maybe you don't want to enter your credit card information on yet another website. Just click the PayPal logo, verify your identity, and you're done. Or just Venmo someone using the PayPal subsidiary. PayPal is also a popular choice for sending money, though we found better options with fewer fees. PayPal became an OG of fintech startups because it has the primary payments processor for nearly 25 years. In fact, eBay was PayPal's parent company for 12 years, before they separated in 2015. The bad blood between them got particularly nasty in 2018 when eBay started going steady with Adyen, who took PayPal's spot as the company's payment processor. But Adyen is not PayPal. Adyen offers an enterprise solution for businesses to eliminate the complexities of accepting payments. It's able to handle more than 250 types of payment acceptance and is available in more than 120 currencies. It operates behind the scenes to provide merchants with a standardized business infrastructure for authorizing payments across their sales channels online, in-app and in-store, without taking attention away from their core business. It's not a consumer product with name recognition like PayPal or Venmo. As you might expect, with a world that is increasingly becoming more automated, a company specializing in digital payment processing did pretty well in 2021. The company raised $266 million in funds for 4 years before going public in 2018, and a market downturn and one previously seen market decline 4 years after this. And shares are now trading at more than $1,650 each on the Amsterdam Stock Exchange. Described as the fastest growing technology company, Ayden increased revenues by more than 60% to about $6.4 billion last year, with earnings up more than 55% to about $500 million. The company derives most of its revenue from settlement and processing fees they charge to merchants. This so-called interchange model means they charge a nominal processing fee per transaction plus a little bit on top of what each third-party vendor charges. For example, a merchant will be charged 3% for Alipay, but between 3 and 7% for something called U-Money, plus 11 cents in total. Their prices are transparent and published online. The majority of its annual volume growth occurred from merchants already on its platform and was better than 80% since the 2018 IPO. POS volumes account for 13% of that amount, but increased to 100% this year as Ayden shifted focus to that segment of the business. The company seems fairly pleased with its results, considering there is already a lot of competition developing POS solutions. Revenues and costs emanating from sales of goods are linked to this part of the business, like the sale of POS terminals. Ayden does not accept any kind of cryptocurrency, after briefly flirting with Bitcoin a few years back. Pieter Van Der Does, the firm's CEO and co-founder, told CNBC that crypto is too volatile for making transactions and that his company has no interest in adding it as a payment method. Bitcoin is more of an investment asset than a payment method, Van Der Does said in an interview last year. While we hold just a bit of Bitcoin for the sake of diversity, we have long viewed the crypto world at large as another get-rich-fast scheme. Glad to see that Ayden has come to the same conclusion. Payments processing is their main competency, but Ayden continues diversifying into other financial services since 2019. They have a credit card issuing service that customers can manage themselves, and they will roll it into the broader financial product suite in the future. Among the forthcoming products are multi-currency accounts that enable users to receive payments, engage in payouts, and safely store money all in one place. These accounts also enable significant platform clients, like eBay, to extend financing to small businesses on a risk-based basis. Ayden has developed its own machine learning software to prevent fraud, providing business intelligence from data and optimize the millions of transactions that flow through the platform. Its AI algorithm is homegrown and unlike PayPal's acquisition strategy. With the growth of the company, the algorithms and other technologies are earning their keep. It's no secret that these big brains in charge receive meaningful compensation with benefits such as a standard European work life, which has been found to make people happy. In fact, detailing certain factors, such as social and environmental responsibility, Ayden has nearly 30 pages explaining decision-making to employees with qualitative analysis and saving this planet. This only becomes concernful when a company sacrifices profitability for bourgeois causes. The Dutch always rank high on these who are the happiest people on earth rankings, so you can expect wage increases from there too in the annual financial overview. When it comes to ESG efforts, much of the company's goals are linked to its technology, as well by providing ways for charitable giving and carbon offsets without charging fees. These sound like meaningful measures that can also pander the environmental activists at the same time. We're just not sure if they actually go beyond window dressing, so we'll let them keep the changes around ESG guidance because it doesn't appear they're doing anything more than serving the needs of their shareholders. Number 3. Upstart Holdings. Finally, add Upstart Holdings to your list of fintech stocks you can invest in for less than $100 per share. Odds are you're not familiar with it because it's doing what credit bureaus like TransUnion and Equifax arguably should be doing but don't, providing prospective lenders with the most accurate picture possible of a potential borrower's true creditworthiness. Upstart provides a more time-efficient, data and machine learning-driven algorithm than the traditional way loans are approved and has leveraged it to successfully reduce default rates. The algorithm looks at large companies instead of just income and past payment history, leading to fewer defaults. Furthermore, this algorithm has allowed lenders to approve 173% more loans. In other words, it's good for both the borrower and the lender. And lenders are finally catching on. As of this year, Sharon View Federal Credit Union, Firstmark Credit Union, Red Rocks Credit Union, and Oriental Bank have all tapped Upstart Holdings to make more informed decisions on potential loans. This increase in options is driving this company's projected top-line growth to 48% in 2018. Upstart Holdings has reported stunning first-quarter earnings, but the company slashed its full-year growth forecast and is considered susceptible to the current macroeconomic uncertainty. UPST in San Mateo, California operates a cloud-based artificial intelligence lending program in the United States of America. It recently reported solid first-quarter earnings results with 156% year-over-year increase in revenues to $310 million. However, the company cut its full-year revenue forecast from $1.25 to $1.40 billion on concerns about declining lending activity due to the aggressive interest rates and rising default rates. Atlantic Equities downgraded UPS to neutral, reduced the target price from $245 to $45 and lowered its outlook on the stock. The stock has declined 68.8% in price over the past month and is currently trading 93% below its all-time high of $401.49, which it hit on October 15, 2021. So UPS Tech's near-term prospects look bleak. Incredibly, UPST has a trailing 12-month net income margin that is 48.4% lower than the industry average, and a trailing 12-month CAPEX to sales ratio that is 39.4% lower than the industry average. Further, this company's trailing 12-month EBIT margin is 37.7% lower than the industry average, which is less than respectable. With multiple advantage over the market, UPST's forward EV/EBIT ratio is 878%. However, it still commands a 3.25 times forward PB valuation. Furthermore, the stock's 16.43 times forward non-GAAP PE ratio is 62% higher than the 10.13 times industry average. UPST has a D rating, which counts as sell in POWR ratings, with 118 factors taken into account and each factor given the appropriate weight. The rating system is comprehensive and includes information about each stock's financials, as well as how they rank according to quality. UPST ranks low in terms of profitability, with a C grade in quality. There is a beta of 2.23 consistent with the stock's F grade for stability. In addition, analysts expect its EPS to decline 48.4% in the current quarter and 22.3% in the current year, justifying a C grade for growth and an F grade for sentiment. The momentum has declined as well, with an 88.6% loss over the past 6 months and 81.5% decline year-to-date, resulting in a D grade for momentum. UPST trades below its 50-day and 200-day moving averages of $97.52 and $179.64 respectively. Moreover, the company could decline in the near term due to macroeconomic fears currently prevalent, because investors are looking at the stock as overvalued and because of limited upside to short positions. We recommend avoiding this stock now. While UPST has an overall power rating of D, investors might want to consider buying into following stocks of financial services with a strong buy or buy rating: Forrester Research Incorporated, Every Holdings Incorporated, and Consumer Portfolio Services Incorporated. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel. And if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you on the next one.